All right, so this is our discussion outline here. You can see specifically, we're going to do introductions, like I said, credit matters, build your budget, protect your identity, and then also invest in your future. For those who are not familiar, my name is Jakari Henderson. I am the president of the Gamma Kappa Omega chapter. I also have an MPA, so a Master's of Public Administration. And then more recently, I became a nationally certified financial counselor. I'm going to allow my soror Monica to introduce herself and tell a little bit about herself.
Hello, everyone. My name is Monica Disro. I have an MBA in accounting. Undergrad was in finance. Right now, I am a finance manager. I've been in accounting and finance for over 20 years plus. I own my own firms. I do bookkeeping and taxes as well. I'm a licensed life insurance agent, and I have my own agency for agents. And I also have my real estate license as well. So just a brief intro.
Okay, so Brianna.
Hi, everyone. My name is Brianna Clemens, and I have my undergraduate degree in finance. My master's is in business administration. I am licensed to be a stockbroker. I have been in the finance field for about 8 years now, and most of that was in banking, as well as investing, the stock market like that. And then now currently I am in the mortgage industry. So that's pretty much a general brief information about myself.
Thank you, Source. All right, so we're going to continue on. I will be covering the credit matters section. And so we're going to be discussing specifically what makes up a credit score, how to improve your credit, and a number of different other things for you to be educated and aware about. So what is a credit score? You can see specifically on the picture that we have here, different ratings. So we have something that starts at 360, which is considered to be poor, which is considered to be a bad score, versus an 800, which is considered to be excellent. So you can see specifically that they will vary between 300 and the 850 range. So obviously the higher your score, the more opportunities and more advantages that you can take of as far as, you know, your interest rates, mortgage, loans, and et cetera. So how reliable a person's payment history is very important because, again, like I said, the higher your score, the more opportunities that you will be afforded. So here again, you can see credit score factors that we include specifically when you are thinking about getting credit or also just even, you know, getting a mortgage loan or an auto loan. You can see the scale here ranges again from that 300 range to the 850. This is specifically what makes up some of those objects specifically within the credit history. So payment history reflects 35% of your credit. So this includes how often you have made your payments, if you've made minimum payments, if you've been late on your payments. Very important to make sure that you are taking care of, you know, making sure you're doing your payments on time and whatnot. And I'm sorry, you guys, I'm getting people to add in here. The amounts that you owe make up 30% of your credit. So this includes specifically your balances, the number of different credit cards that you may have, with whether it's a realtor, whether it's, you know, an auto loan, how much of that balance have you utilized? So let's just say you have a credit card that has a balance of $5,000. Well, let's say you've utilized $4,500. You're clearly exceeding over 30%, which can ding your credit score a lot. So we do recommend that individuals not overextend 30% of their credit card balance because, again, like I said, it looks to lenders that you are not necessarily reliable in regards to handling your amount of your balance correctly or properly. So you want to make sure that if you have a credit card that you do not exceed 30% of that balance. Also, the length of your credit history makes up 15%. So this is talking about how long have you established your credit history. So if you maybe had a credit card 7 years ago, 10 years ago, that will also make up, again, like I said, 15% of your. Then we have the two other ones, which are new credit and the type of credit used. So new credit basically is, have you opened up any new credit cards in the last, it could be last few months, last few years. You don't want to have too many of these because they can ding your score as well. And then also the mix of credit that you have. Do you have a lot of, retail credit cards? Do you have a lot of, whether it's traveling, different cards specifically make up this type of. So you want to make sure, again, like I said, that you don't overdo it as far as opening up a lot of credit to try to build your credit. And then you also want to have a good mix as well. You don't want to just have a credit card just to open it to say, I'm trying to build my credit and I want to, get some more balances available for me. You want to make sure you have a well-rounded credit history. Here you can see our three major credit bureaus, typically referred to as FICA. You'll hear people talk about the FICA score. And here you can see specifically for the three different credit bureaus, what they include in their credit reports. You have TransUnion, you have Equifax, you also have Experian. I do want to make sure that everyone is aware that your credit score may vary from each bureau. It's important to know that, and most of the time you won't know specifically until that credit report has been pulled, what score that they're going to, what bureau that they're going to use. So it's important, like I said, to make sure you're taking care of those 5 different breakdowns. So your payment history, the new credit, and et cetera, to make sure that you are not, getting an accurate credit score. And I apologize for the ringing of the phone in the background. Here are some specific things as to why credit is considered low. And this can be short or no credit history, your late or missed payments, if you have a high balance. So again, I talked about having over 30% of your credit use, this will ding your score. If you have too many credit accounts that are open, if you have a lot of recent credit inquiries, if you have multiple delinquent accounts, these are all things that will make sure you get a lower score every month. So you want to make sure that you're maintaining and taking care of your credit. It's very important. As many of you may know, it's important when you're trying to get a new car, when you're trying to buy a home, if you're trying to, establish credit. It is more hard for individuals who start off with a lower credit score, who have a number of these different things listed there, versus someone who may have a higher credit score, who may have, a month or something where they may have some issues specifically. So it's important, like I said, to make sure that you're taking care of these things so that you are not putting yourself at risk to ding your credit score. So how do you raise your credit score? These are just some tips. You want to make sure that you're paying your bills on time. It's very important. Like I said, if you have late payments, it indicates to lenders that you're unreliable and that you do not pay your bills on time. Secondly, you want to avoid collections. This will ding your credit score as well. You want to make sure that you're paying any bills, outstanding bills that you may have, and doing what you need to do to make sure that you're avoiding any collections if possible. You want to keep those balances low. Again, you don't want to utilize more than 30% specifically of your credit card's balance. It will ding your credit score significantly. In addition to that, you don't want to open up too many accounts that are not necessary. So again, that mixture of your credit. You don't want to just open a credit card because you want to say, oh, I'm trying to, improve my credit score. I want to apply for all of these credit cards. If you don't need it, don't apply for it. You want to negotiate payment plans. So let's say in the event that you've, experiencing some type of hardship, you lost a job, and you're trying to navigate and figure out how are you going to pay your bills. You want to contact your lenders. If you don't say anything, then they won't know. If you're having issues meeting the payment plans or meeting the payment that you already have kind of established, contact your lender and they will be willing to work with you what best kind of fits specifically your needs. Do not consolidate unless you absolutely have to. So here are some different types of credit. So you have secured credit. So it's any loan backed by collateral. So when I talk about this, I'm talking about a mortgage. Your home is backed specifically by that, or an auto loan. Unsecured credit is any loan that is not backed by collateral. So an example of this specifically would be like a credit card or something like that, that they would have to come after you for because it's not backed by any collateral that can be actually taken from you. You also have installment credit, which is any loan that is repaid in equal installments. And then you also have non-installment credit. So this is any loan that is paid in one large lump sum amount. So these are the different types of credit that an individual may have over the course of years. This does include for non-installment payments. It can be like a light bill, phone bill, things of that nature. Here are some different type of credit cards that individuals may be aware of that you may have access to, that include your bank card. So obviously many of us have bank accounts where you may have, you know, a checking account, a savings account, a credit union, and then you have your travel and entertainment cards. So these are items that you can, you know, use for items or for service that many individuals take advantage of because there's points and different things that you can get by using those cards. And then you have your merchant cards. So these are cards that are offered by major department stores that you can normally use to shop. So we're talking, you know, Target, you know, Victoria's Secret, a number of other different places. And then you have your secure credit cards that draw from deposited funds that consumer has in an account. So these are, like I said, a number of different types of credit. And then with credit cards, we all know you want to use those responsibly, because if you do not, then you may put yourself in a predicament where you're lowering your credit score or putting yourself into a position where you're not making necessarily the most fiscally responsible decisions. So here are some of the credit card fees that are associated with credit cards. So you have your late payment fee that credit card lenders will impose on a consumer. You have over the limit. So if you spend over your balance limit, you can be charged a fee for that. You have your fees. You also have transaction fees and cash advance fees and early payoff fees. So it's very important that you read the fine line and fine print of your credit card because again, some of them will be a little bit, can sometimes potentially be confusing to some consumers. And so if you have questions, reach out to your lenders. It is your right specifically as a consumer to know what the APR is, know what those fees are for those credit cards that you have. Okay, so please make sure that you are educating yourselves and you know specifically what those fees are. All right, and then we also have, proper credit usage. So these are just some tips specifically to make sure that you're ensuring that you are using your credit cards properly. So you want to limit the number of your credits that you maintain to a maximum of 3. I say if you have 3 specifically that you need, you want to use these, especially if you're struggling with, being fiscally responsible with your credit or how you spend money. I've set a maximum for myself as 3, and I don't try to go over that. You want to avoid cards specifically with early interest posting dates. You do not want to exceed that 30% balance. You want to maintain that 30% or keep it less. I would recommend less if you can. You want to avoid cards with high interest fees. And then you also want to avoid cards with complicated billing procedures. Again, this is very, like I said, important for consumers to know about their lenders, because this is where a lot of big consumers will fall victim to not knowing the terms that they signed on for credit cards. So you want to make sure that you're educating yourself to know specifically what that looks like for you. And then lastly, you want to make sure that you're paying more than the monthly minimum fee. If you just pay specifically the month balance, let's say you're paying, your card amount is $30 and you're only paying $30. Well, depending on specifically how long you've had that balance established, they're going to start to tack on fees for that. So you want to make sure, even if it's $2, $3 more, you want to make sure that you're paying above the monthly minimum. It's essential. When you want to qualify for credit, what we call as ASAP, you want to make sure they're going to look at specifically that you have the ability to pay the money back, stability, that you have a job to pay those funds back, you have assets that you can basically state that you have, and then also your performance. How have you paid on the credit cards that you've already had? If you have an auto loan, have you made those payments on time? Are you making the minimum balance payments? So you want to make sure that you have all of these 4 things established when you're trying to qualify for credit as soon as possible. Canceling a credit card is also very important. You want to make sure that in the event that you're not utilizing a credit card, that you don't continue to have that if there's no need for you to have it. You want to make sure that you pay off the balance before you close your credit card. It is never good policy to close a card and you have a $1,500 balance or even a $25 balance, because again, that balance is still owed to you. You want to notify the card issuer by phone and let them know that you would like to cancel the credit card upon the consumer's request. And whenever you see your credit report, you want to make sure you identify that on there, that it was closed specifically by the consumers upon their request. If you have not received, any follow-up, if you didn't see that your credit card had been closed, you want to make sure that you're following up in writing to ensure that that credit card has been closed, that you don't have any balances, because again, it is still your legal responsibility for whatever balance that you may have had on that credit report, on that balance of that credit card. And then lastly, you want to check your credit report. Again, like I said, you want to make sure that the card has been canceled. If you have been the individual to cancel it, you want to make sure that that is listed as so. All right, so we're going to do a little pop quiz. So this is our first question, and I want to kind of share this with the group. I want to get some feedback, kind of do some games. So if everyone could just put their answer, what they think this first question is, we'll give you guys a few seconds to do so. So we have 7 of the 14. I'm going to go ahead and give you guys another 30 seconds. Come on, we only got half. I need a couple more people to respond. Okay, I'll give you guys 15 more seconds. We're getting there. Okay, anybody want to raise their hand and answer? I see what we have here. So the question was, which Black revolutionary will be the face on the $20 bill? And the choices were Booker T. Washington, Frederick Douglass, Harriet Tubman, or Dr. Martin Luther King Jr. Does someone want to blurt out an answer that they think that the answer is?
Harriet Tubman.
That is correct. Thank you so much, Ms. Coleman. All right, so I am now going to turn it over to Monica Disro, who will discuss budgeting.
Good evening, everyone. Again, I'm Monica Disro, so I'm going to go over budgeting. So I have several subtopics that I'm going to go over. And more so, this is pretty much a portion of financial planning. So I'm going to also get into what comes even after budgeting when you are preparing to have a safety nest, because that's also part of budgeting. So right now, what is your budget? So let's just a brief summary. Budgeting is a planning tool. It means that you are spending with purpose. So at its simplest, a budget lists how much income you have coming in compared to what's going out each month. So you can look into creating a detailed budget, which will allow you to make your financial decisions. It gives you a picture on where you stand at the beginning of the month and where you will end at the end of the month. So at the beginning of the month, you'll be able to plan accordingly. And then at the end of the month, you'll know if you have a surplus left over or not, and then what to do with that surplus. Okay, so how to create a budget. First, a lot of people have heard a zero-based budget. We also start sometimes with what we see in our actuals where we're actually spending. So what that will give us, whether we use a zero-based budget or look at our actual spending, it'll allow us to see how to allocate our income. So allocating our income should be allocated according to our monthly expenses. But again, what is our income? Our income is any monies that you're making during the month. So you will need to calculate money that you have coming in from a W-2 job, a regular job, any hustles you have on the side, any hobbies that you make money from, anything that's regular income for you, and also irregular income for you. You want to plan all of your income. All of that income coming in is calculated against all of your expenses or your monthly costs going out. And typically here, I'm speaking on a monthly budget. So to calculate your expenses, sometimes you can look directly into your bank statements. If you have no idea, look to where you have been spending. So look at your monthly bank statements and categorize everything that you've been spending. So again, also there's useful tools that you can have. Sometimes good old fashioned pen and paper will work, but outside of that, there's several tools and apps out there. Mint is a very popular app. Another app is Pocket Guard and Good Budget. So use any tool that you're familiar with or that you feel comfortable with. A lot of times you just have to dive in and see what works best for you. Okay, next. Okay, now that you have a budget, one thing that you don't want to miss is planning for any big purchases. You want to plan those things out over the course of a few months. Again, once you're looking at all of your income coming in and all of your expenses going out, if you have a surplus, that surplus can be used towards big purchases. Sometimes we see things in the store and we want to grab them very quickly. You know, I'm excited about having this item, but if it's not in your current budget, hold off as much as you can and plan that expense out, plan that cost out, plan it over the course of a few months. You'll feel less guilty and more of a reward that you've actually stuck it out and disciplined yourself and earned that item that way. So take time to think over large purchases. Also, you need to plan accordingly for a safety net. I believe it's an item that should not be missed. It is something that you plan. It's just like a necessity. We all have emergencies that occur, whether it be a car repair, whether it be a pandemic, things like that. You would have had a little less stress or at least some comfort knowing that you had a small safety net or some sort of safety net to get you through those times. So always prepare to weather some type of financial storm. Keep it in your budget as if it is a necessity. Some things that can help you plan for that safety net is to cut out any unnecessary costs. Some things kind of happened for us. So when nail shops were cut down, we were able to save some of that cost strictly because they were not available. So if you think how you were able to do without that for that time period kind of forced upon you, then you can think what you can do if you discipline yourself and how much money you can actually set aside if you set aside that money with purpose. So it can include your emergency fund as if it is a necessity. All righty, so we always want to track our progress. We want to know whether we're succeeding or failing at our budget. Each month, if you come up in the red, which means that your costs are exceeding your income, then you would feel, okay, you're not succeeding here, and you have opportunity to tweak and to change some items within your budget to get you out of the red and into the black. So just track your progress. A lot of times our bank, you can actually set up in your checking account to receive notifications. Turn those notifications on. Do not be hesitant to see what's going on in and out of your account. Don't be hesitant to see how you're tracking, whether you're tracking your budget monthly. So some people get paid monthly and they create a monthly budget. Some people get paid bi-weekly and they create a bi-weekly budget. However you create your budget, make certain that you're checking your progress in the times in between. So you don't want to wait 30 days and then say, okay, how did I do? You want to check weekly. You want to check those notifications, set those notifications so they go off anytime there is a deposit. And sometimes you can check if you have a withdrawal over $50 or at, you can actually track to see, okay, when I spend so much money towards gasoline, if it goes over that buffer, then notify me. So use any kind of tool that you have to create a way for you to track your progress. Then also in your budget, again, outside of the safety nets, you can create a buffer. Sometimes it's hard to track certain things like utility bills. It's hard to say exactly what it's going to be each month, but you can have a certain range. So if you know, okay, it definitely never exceeds more than $300. So I keep my budget at the higher end in that category of utilities. I'm not going to go on the lower end because it was in the summer months. So my heating costs went down to 170, which is about 60% of where it could be in the winter. So always create a buffer. You want to track sometimes on the higher end because anything that's in the surplus, again, means you succeeded in keeping to your budget. So you don't ever want to be in the red. So create a buffer. Again, use those resources, use notifications, just keep yourself disciplined to track your progress, not just waiting to the end of the month, but track it in between time as well. And also setting goals. What is the goal of your budget? Your goal of your budget should really meet or get you to your yearly plan, your yearly financial plan. So if you're planning to purchase a car because you know, okay, I've actually had a lot of car repairs, so I've been eating up my emergency fund more so towards these car repairs. So now I think, okay, by the end of the year, 6 months from now, I want to purchase a car. Then you can set that goal within your budget. You can say, okay, I want to have a $3,000 down payment. Let me split that across the next 7 or 8 months or so. So again, make certain that your financial goals is also included within your budget. All righty, so sometimes we are in the red when it comes to our budget, means that we have more costs going out than we have money coming in. And what possibly could we do when that happens? There's a lot of things that you can do to actually create some money on the side. You can sell items using eBay or whatever, Amazon, what have you. If you have a certain skill set, if you have a certain hobby, try to make that into some side income, some additional money, revenue for you. If you have the time, if you have the commitment, you can always pick up a new skill. There's a lot of jobs that you can do remotely, insurance sales, you can do real estate part-time. There's a lot of things like that, that if you commit to picking up another license could bring in a lot of additional income. So if you are coming up in the red, just take a deep breath, relax, and just try to think outside the box and find some additional ways to earn some additional income. And building your budget, part of your budget, your surplus or your budget should include a portion of your income or a portion of costs to cover debt. But debt is something that is not a necessity. So you should always be planning on how to bring that debt down and to decrease that debt with any surplus that you have in your budget. So you have in your budget, you know, your regular credit card payment, but you don't want to just continue to balance and just pay that credit card until infinity. You want to pay that credit card off and definitely keep it below that 30% threshold. But if it's above there, then you can include what's called or use what's called the Snowball Method. Now they have the Avalanche Method, which is the opposite, but this method here is you take the smallest credit card or the smallest debt value. So you will go from $100 to $1,000 and start by paying off the smallest item first. And whatever monies you were using to pay off that smallest item, you use that income or use that surplus now to pay off the next largest dollar value. So you go from $100, the next credit card is like $500. So now instead of paying, you know, 30 on the regular monthly fee and then an extra $50, now you can take $80 and pay it on the next item and pay it down. And you just repeat and you repeat and you repeat until now you're actually making above and beyond the minimum balance plus that surplus, and you're just knocking that debt down. Because again, debt is not a necessity. You really want to have your funds available for yourself to reward yourself you know, you see yourself, again, we're watching our progress and we're seeing we're succeeding with our budget. Eventually, we're going to get to some place where we say, okay, maybe I can even include in my budget something else outside of just bills. So budget maintenance, let me go because I have a couple notes over here. Budget maintenance, I call that sticking to your budget. How do you actually stick to your budget? Notifications actually do help. When you're getting a notification that your balance is in the negative, it is a red flag. It alerts you. It is shocking. It's like, I have to do something. And I never want to, you know, typically when you have ever experienced that, it's not something you want to experience again and again. So you kind of kick yourself in the butt and you say, okay, I've got to do something different. I've got to maintain myself within these budget limits. I cannot exceed the budget limits. I don't want to go into the red. I don't want to go into a negative balance in my account. I know I'm going to get that notification. I've set that tool in place to notify me, but what can I do in the in-between time? Again, go back to checking your account regularly. Go back to reviewing your budget tool, whether that's pen and paper, what you have planned out, whether it's Mint. Use whatever tool that you need to maintain your budget. You're looking at it often enough to know I need to squeeze here or I have room there. So after you create your budget, you want to monitor those outcomes. Then you need to adjust if you need be. And then again, once you make those adjustments, if you are exceeding that expectation, then you can actually see what you can do with that surplus and see how it meets your long-term financial goals. And that's it. We're down to another poll.
I'm going to give everybody a minute to answer the second question. Twenty more seconds, guys. Okay, Brianna, I'm gonna let you chime in on this one. So you see the end of you see the poll results there? Okay,
No, I can't see the results. Okay, now I can. Okay, so the question is, who was the first Black millionaire? So this is very much a trick question because there is one specific person that has been highlighted as the first, self-made Black millionaire. Got a lot of praise, got their own Netflix little movie and etc. And it looks like 91% of the people that answered the poll answered that person, which is Madam C.J. Walker. We definitely want to highlight our women that's self-made, doing great things, but that is unfortunately the wrong answer. The right answer is William Lansdorf. He is actually the first Black millionaire. He is known as the founding father of the state of California. And this was back in the 1800s. So that was way before Madam C.J. Walker's time. But the other people on the question is also, they were part of the Black millionaire list as well. They're just not people that are known like Madam C.J. Walker was whenever she came about and was able to come to her successes. So Madam C.J. Walker is unfortunately the wrong answer. But all of these people are Black millionaires, and they're able to overcome oppression and do great things back in the 1800s, 1900s. So yeah. That's just a fun fact because myself, I didn't know that right answer until I looked it up and kind of did a little further research. Okay, so Whenever we discuss, building our financial brand, a lot of the times, we're looking at how we improve our credit, how we budget properly, how we do all of these things so that we're able to make money and able to keep money. But one thing that we kind of forget about is how to protect our financial brand and how to protect it by protecting our identity simply. Because, whenever you have someone that does take your identity or does anything with that, that negatively impacts you across the board to where your credit goes down, to where, the amount that you budgeted for, that emergency fund, you now have to use it because for certain reasons, something happened. So whenever we're thinking of identity theft, it's basically when someone uses your personal information without your permission. And your personal information is combined of uniquely identifying factors like your name, your age, your social security number, things of that nature that not everyone has. No one's going to share that. Even if you share a name with someone or a birth date, more than likely they don't have your social security number, and they shouldn't live at the same address as you at the same time. So that's going to be what identity theft is, and then your personal information. You can go on your card. So how can your identity get stolen? There's plenty of ways. People are getting clever and clever as the years go on, especially like with technology advancing as quickly as it is. You're going to see it online by email, scammers coming at you over the phone, through the email, except popping up at your house maybe. If you're shopping with compromised companies, so you go online, shop at Target. If Target got compromised and you use your debit card to make your payment online, more than likely your information is now out there to whoever hacked their system. If you're not actively checking your mail, if your mailbox is accessible to the public, they can easily go in there, get your documents, and be able to use your personal information that way. If you're browsing online on corrupted sites, whenever you put in your debit card or credit card number, usually hackers are able to match your keystrokes, and so they now have that account information. So that way, you can kind of use third-party payment services like PayPal or something along those lines where you're not using your direct account information. Then you want to make sure you're discarding your documents securely, because whenever you do that unsecurely, like just throwing it away, anyone has access to that. As well as if you have, like a medical or business office that holds your personal information, if someone hacks their system, goes into the office and steal files for whatever reason, now your information is out there to the public and it's vulnerable. So whenever your identity is stolen, new accounts are able to be opened in your name. That's going to be like credit cards, bank accounts. Someone could possibly buy a car. They can pretty much do anything when they have your personal information. They are now you, essentially. Criminal activity can be done in your name. They could get pulled over by the police or whatever may have you, and then now they can use your information. They can even possibly make fake IDs. The risk is just endless on what they can do when they have that sensitive information. And again, like I mentioned before, this would negatively impact your credit score because, as Jakari mentioned, whenever you have new accounts being opened and then the balances are high or the payments are now negligent because you didn't have any idea of these, new accounts being opened, your credit score will go down tremendously because of this negligent behavior, because someone stole your identity and opened new accounts. So whenever this happens, you want to make sure that you act fast. You want to place a fraud alert. You want to order your credit report so you can go through and make sure that what's on there is legitimate. And if it's not, those are the things that you want to dispute. Whenever you submit an identity theft report, usually you have to file a report with the police as well. So there's some type of paper trail to say, okay, this is a legit claim, and let's do something to, remedy what has happened. As well as you want to make sure that you're freezing your credit and bank accounts. And so that way, if someone does try to open a new credit card account or a bank account, the system, that company or the institutional will be alert to let them know that, they have to kind of monitor this because of the situation at hand. So that will be some ways that it will help you if your identity is stolen. You can prevent it by monitoring your credit and bank statements, checking your mail often, not replying to unsecured emails, getting your annual credit reports, and sign up for alerts. I have a credit card through Discover, and they always send me an alert if my credit score goes up, goes down, if there's a new account open, any of those things directly to my phone or my email. And that keeps you able to up and current with what's going on. As well as, you want to make sure you're shopping on secure websites, store important documents in safe places. If you have a safe deposit box, anything with a lock and key is your best bet. Shred or discard any sensitive paperwork. You can tear it up, burn it, whatever. And also you want to make sure you're using difficult passwords. Your name plus the digits 1, 2, 3 for every single account that you own is not a smart choice. That's not a smart idea because it kind of makes it easy to hack your accounts. And you also want to read your bills carefully. You want to make sure that you did in fact make that payment, make that withdrawal, and et cetera, that all of those things are legitimate and they are things that you have done. So the 3 major credit bureaus I was mentioned earlier, you have Equifax, Experian, and TransUnion. They all have their own individual 1-800 numbers that you can contact whenever you do come across any fraudulent activity. And then whenever you're ready to submit an identity theft report, you want to do that by going to the Federal Trade Commission, by also contacting their 1-800 number. You can simply go to ftc.gov and be able to do that online. So that pretty much just wraps up identity theft. It's pretty simple, straight to the point. Many people don't think about it and they just go on and thinking, they're invincible and it won't happen. And unfortunately, it does happen pretty often. So now we're going to go on to our third and final poll question here. And that should be coming up shortly for everyone.
And I'll give everybody 1 minute to answer this. Everyone has 30 more seconds. We have about 7 more people to answer.
Okay, so we have our results in. So the question is, do Black families educate their children about finances more or less than Caucasian families? And majority of you said that Black families educate our children less than Caucasian families. Only one person said more. And this is just a preconceived notion that we have, I think pretty much just across the board, just in society to think that, but that's actually incorrect. Black families educate their children on finances at 58% versus 48%, which is Caucasians. Simply because, just wanting to break that generational curse. And then more of us are being, educated and putting a lot of importance on our finances. So we're trying to get that information and pass it along to our children, having talks like we are right now. So it is more prevalent than we think, but yeah, we lead that at 58% versus our counterparts. Okay, so this is our last segment of the night, and we're going to talk about investing. So investing in your future. So whenever anyone thinks about saving money, that's going to kind of go into what Monica was mentioning earlier. So whenever you're saving money, you're actually using that excess amount of money that you have from your income, and you're putting that away. So if you budgeted that you want a certain amount set to the side, this would be the money that you're what we would call saving. So with this money that you're saving, it could be used for a short-term goal to a long-term goal. If you want to go on a vacation, if you want to save up for your wedding, a new car, college tuition, whatever it is, basically you're just putting money away, setting it to the side, and you're just wanting it to stay that way. You want to be able to have that emergency fund and things like that. But whenever we're talking about investing is a little bit different. You can actually fund your investments through the money that you save, But when you invest, you actually want that money to grow. You don't want it to grow based off you put in dollar by dollar by dollar in. You want to put that dollar in and you want that dollar to work for itself. You want that dollar to accumulate and make its own money so it can grow. And so that's the biggest difference between when you're saving and when you're investing, is because when you invest, you give yourself the opportunity to gain capital on whatever your initial deposit is. And that can be for retirement or just for passive income, like I said before, just to be able to make the money work for itself. And so you ask, like, why would you choose investing? So whenever you think about a savings account, you are subjected to a lot of inflation risk. That dollar you put in 10 years ago, it doesn't equal the same dollar amount if you took it out today. And whenever you have a savings account, you only bear about 1% of interest, if that. So the money that you're getting on that interest in the savings account is pennies. It's nothing compared to if you have an actual investment account and you're putting money into there, because although you are subjected to many risks, the growth can be exponentially. It goes back to the saying, the higher the risk, the higher the reward. And then your investment goals can vary based on your age, your income, and risk tolerance. So if you're young and you just started or finished college, you have a high risk tolerance. You have a large gap into the retirement age. So you can risk it all for the most part. It's not anything that you're that dependent on at that moment. But when you start to move on and you're at the middle age and you're starting a family, you still have a higher risk tolerance, but it's not that high, because now you're thinking about your children. You have this legacy that you want to look after, and you still want to make smart decisions. You don't want to go too overboard. But when you're at the retirement age, you don't want any risk. You want fixed income, you want monthly payments, you want to sit back, be on the beach, sit back on the beach on your vacation and not have to worry about losing money. Because at that point, you should have made all the money you need to fund your life until you pass. So that's kind of where that happens whenever you set up an investment goal. So there are different retirement accounts. The most popular retirement account is your 401k. That's because it's an employer-sponsored plan. Basically, it allows the employee to make contributions to their 401k with their paycheck. And what an employer may do is match whatever amount was set to the side. So if an employee selects that they want to contribute about 2%, an employer may match that 2% with another 2% contribution. So it's technically free money. But sometimes, employers have stipulations on that. You have to be there for at least a year, or they want you to set aside a larger amount. So they may say, unless you're setting aside 3% or higher, they won't match anything. So it's really just dependent on the company. But that is the one that's kind of most talked about. It's the 401k, 401k, 401k. You hear that a lot. And that's just pretty much that employer-sponsored plan. The traditional IRA, however, is just a little bit different. It has the same concept. It allows for an individual to make tax advantage contributions and earn tax-deferred earnings. So with your 401k, it's going to be used from your paycheck. And then also with your traditional IRA, it's also money that is from whatever you make. But it's not necessarily drawn to work like a company and an employer or anything like that. You do have contribution limits though. You can only make a contribution of $6,000 if you're lower the age of 50. But if you're above the age, if you're 50 and above, you can make a contribution to up to $7,000. And this changes year by year, but those are the current contribution limits. However, if you want to withdraw any money, you have to wait until you're 59 and a half. If you take out any money before then, there's a 10% penalty, unless it's a qualified exception, which you could say like you're a first-time home buyer, you want to withdraw some money. I believe it allows you to up to like $10,000 for like a down payment on a home at your first home and things like that. You kind of go into the weeds of that. But if it's qualified, you can take out money before you're 59 and a half. But usually the general rule of thumb is 59 and a half and above. You could take it out without that penalty. You just be taxed at your income tax rate, whatever it is at that point. So whenever we look at a Roth IRA, it's very much similar to a traditional IRA. The main difference is that this retirement account is funded with after-tax money. So the money that you would have received for your check from your net pay, that is what they're going to take to put into the Roth IRA. However, not everyone is able to get a Roth IRA account. You only can get it if you have earned income that is proven that you earned it in a legitimate and in a legit way, I guess you could say. And if you make too much money, you cannot open a Roth IRA. The maximum gross income amount changes. I believe right now it's about 140,000. So anyone that makes above that amount, you cannot open a Roth IRA account. But the advantages are basically that this money will grow. And usually people want this because if they get taxed at 30 years old, their tax income rate is lower than whenever they're ready to take the money out when they're 70 plus. They believe that at 70 and above, your tax rate may be higher, and you don't want to tax at that higher rate. You rather be taxed when it's lower, when your income tax rate is lower. So then obviously you save more money that way. And the simplest SEP IRA, those are just basically catered to small businesses, self-employed operations, to where you have like 100 or fewer employees. And that way you kind of give them some options whenever it comes to retirement. So moving on to brokerage accounts. So these are different from your retirement account. Brokerage accounts kind of have the same functionalities as a bank account, where you basically put in money, and then with the money you put in there, you can buy things. With a brokerage account, what you're buying is in the financial market. You're going to be able to trade in the financial market with the funds that you deposited. You can withdraw at any time. There's no penalty or anything like that. So the individual account, those are for just single investors. You can even have a joint account with like your spouse, or with anyone if you have like an investment club, group, etc. Those basically are catered to like a bank account. It has the same functionality, but again, it's for the financial market, is what you're going to be purchasing with those funds. Moving on to a UGMA account, that stands for Uniform Give to Minors. Basically what this is like a custodial account. You have the account set up for a minor. It can hold assets up to the time that they reach the legal age, which could be 18 to 21, depending on the state. Again, this is similar to a bank account. If you open a bank account for a minor, they are the beneficiary. However, there's a custodian there to manage it. And then usually with these types of accounts, whenever you make a withdrawal, there are some stipulations. They want to make sure that the funds are being used for the minor specifically, and not just for whoever. And then the Coverdell is an education savings account. It allows you to use the funds in that account from the investments for educational purposes from kindergarten to grade 12. There is a contribution limit on these accounts. It's up to $2,000 a year. So it's not too much you can put in there. So the assets classes are basically just what you can place in these types of accounts. If it's a retirement account, if it's just an individual brokerage account, etc., this is what you can hold in these accounts. So stocks, that's basically giving you the opportunity to become a shareholder of a company. If you buy a share of Apple, you are now a shareholder of Apple. And then you have some input on some public related issues, because this is a public traded company. So you can vote and put your input on some of the things that they give out to the public whenever some things come arise. Then moving on to bonds. Bonds are simply like a debt instrument. This gives the opportunity for like governments and companies to be able to fund things by distributing bonds, because what that happens is as a person purchasing that bond, you are now lending money to them. And so what they do in response to that is they're going to pay you monthly payments, semi-annual payments, quarterly payments until the maturity date of that bond. And so that way they're able to pay back that debt. And so you get fixed income. And this would be something that, like I mentioned before, that retirement age person who has low risk, little to no risk, and they just want fixed income and want income to come in, than necessarily losing money, they would kind of go towards a bond. An ETF is basically an exchange traded fund. It's just a basket of securities like anything that would be considered a stock, and you kind of get it at a discount rate, because instead of you just buying one share of Apple, you would have Apple among any other stock that's in that type of sector within this one fund. And it follows the stock exchange the same. It trades throughout the day, everything similar. It just gives you more diversification in your portfolio, as does mutual funds. These are a pool of assets. They're managed by investment groups. So they have higher fees. They only trade once a day, and that's only at the close of market. They're similar to exchange traded funds to where it provides diversification, but there's some higher fees and there's just a little bit of difference between those two. So whenever you're thinking about opening an account, it's pretty much just like your first step on what to do whenever you're wanting to start investing. You can go the route of an online discount broker. It gives you the opportunity to do your trading self-directed with fewer fees and requirements. You don't necessarily need anyone to manage it for you, but you would want to have some type of investment knowledge. You don't want to go into opening that account and then just start trading blindly. That's how you'll easily lose the money that you put in there. And then it kind of, it just goes from there, and it's not really the best decision for that. So you want to make sure you have at least some intermediate type of knowledge whenever you do just open a self-directed account, because no one's going to be there to monitor it for you unless you know someone that is trading or something along those lines. So you do want to have some type of knowledge whenever you're opening self-directed accounts versus a managed account. A type of managed account is like a robo-advisor. That's basically an automated service that they go by your investment knowledge as well as your risk tolerance and make trades or recommendations based on that. If you don't want a live person, that's an option. But the other flip side of that is to actually have a live stockbroker that would do the same things as they would. Might have some higher fees and all of that, but you do have these options when it comes to even a retirement account. You can open your own retirement account and fund it this way. It doesn't necessarily have to be through your employer. But yeah, that's pretty much about it when just to kind of get in just a surface level on how to invest in your future in those different accounts and assets. So now we can open it up for questions on all of the subjects that were covered today. So if anyone has any questions, please raise your hand and we can go from there.
Are there any questions from the group, tips, resources that you guys want to know about? Okay, so April King, I see you've raised your hand. You can go ahead and ask your question first.
Hello. My question is, I could have missed this. Is there any pros, or can you provide any pros and cons on like crypto, or if you're purchasing any stock within crypto, do you have any pros and cons to give more information on that? Because I just recently did that and I just want to know if it was a good idea.
So it's not necessarily a bad idea. Whenever you have something that's new, exciting, that can, make you a buttload of money, there's going to be the good side and the bad side of that. I think with crypto, it's very much a new tool. It's very interesting for a lot of people, and it has made a lot of people money. But again, there's a lot of risk that's associated with that because it is fairly new. So I wouldn't say it's like a bad decision to get into that. I would just say more so, just based on like your risk tolerance, your age, what you're looking for, where your income is. It's just a lot of factors that goes into that to say if it's a perfect fit for you. But if you're comfortable with it and you're comfortable with, growing, and you're going to see a lot of fluctuations. That's number one. It's going to go up and down. It may look good today and it may look horrible next week, but that's just, you kind of have to build your tough skin for that. And you never want to do anything emotionally. You don't want to put your emotions into it because that's how you just make a total bad decision, because you're just going based off emotion, and you kind of panic and you just, you do something, you pull out and you shouldn't. It's just a lot that goes into that. But I would say, for one, you want to do a lot of research on anything that you do. If it's a penny stock up to, like you're saying, cryptocurrency, Bitcoin, anything like that, you just want to put a lot of research into that and just make sure it's a good fit for you. It's not, it's not tailored for everyone, one size fits all, because everyone's financial situations and standings are different. But I'm not opposed to it, and I wouldn't say it's a bad idea. It's just more so what you're comfortable for.
Thank you.
Yeah, no problem. Thanks for asking that question. That was a great question.
Maya, I see you have your hand raised.
Yes, I had a quick question. As far as savings goes, how much should I put away, whether it's like weekly or monthly? Like, what's a good starting amount? Because I use US Bank, And they always have this thing on my app saying, with your amount, you could do like $200. And then I read some things that say start at like, 50. But I was just wondering if you had any suggestions for that.
Monica, do you want to answer this question? Go ahead.
That question, because to me that goes specifically with your budget. That is just a simple equation of how much money you actually have left over for savings. That may not be your situation. If you have less income than costs, then you are not in a situation where you can save. Save when you have a surplus, when you have more money going into your income area as opposed to the costs. So it's a simple equation of that.
And I would also add in that the amount is more so up to you and what you're comfortable with. As Monica mentioned, if you're underwater, don't drown even more. Like that's not it, everyone, I think, so society, social media, they kind of put this pressure on people that you got to save. If you're not saving, you're not using your money smart. But that's just a general statement. That's a blank statement. That doesn't apply to everyone. So it's based on, you have to look at your financial status first. What is your monthly income minus your expenses and your bills, those things that are necessary, and then go from there. You don't want to just save just to say, oh, I'm saving, because okay, that's good. But like I mentioned, you're putting that dollar in, but whenever it's time to withdraw that dollar, it's less than the dollar now. It is not even worth, it's not even the same amount anymore. So you kind of have to look at yourself first, see what works for you, and then go from there. Don't save just to say you're saving. Don't save just to say, oh, I have X amount of money in my savings account. But what is it doing? So it's just more so depending on yourself and what you're comfortable with.
And then I also want to jump into, Brianna, and just add to it, also aligns to with your financial goals that you have set for yourself. If you're working towards maybe buying a house or owning a car, those are things that you want to keep in mind too, or to establish while you're going through the process, so that okay, when you get to a certain point, okay, I need to save this amount for X, Y, and Z. So definitely what Monica and Brianna said, and then like I said, also aligning it with your financial goals that you have, even also paying off your debt, because again, like they said, if you're in the red every month, then you can't really save, a lot. And you want to do what you can to make sure that you are, taking care of the things that you need to take care of at that moment. So, okay, so good question, Maya. Chloe, I see you have your hand raised. We're going to go ahead and go to you.
Okay, I just had a quick question about stocks. So I was interested in investing in stocks, and like I see on my iPhone, there's like a little app that you can see what's going on in the stock market right now. But I was wondering, what are some red flags that you should look for when you're going and trying to put money into these stock like accounts and stuff like that?
So so trying to understand your question. So whenever you're putting money into the account, or like actually buying the stock?
Like buying a stock. Like I know, like to my understanding, there's different websites that you can put stock into. Is there anything that you should be, because I'm afraid that if I was to put stock into a place, it would be like a scam or something like that. Like, are there possible scammers that would just take your money, or is it safe, basically?
Yeah, no, I understand that. A lot of people have like preconceived notions when it comes to investing, and I honestly had some myself before I actually got in that industry. You do look at it as a scam, especially like there was a lot of like Forex groups and stuff going on during the pandemic, so it kind of makes you weary. But I mean, when it comes down to the market itself, it's simple. It's the people that are in the market that can make it a little murky and kind of like, a little sketchy. But if you go to like the major like discount brokers like online, like TD Ameritrade, E-Trade, things of that nature, I believe there's a lot of them. Those aren't going to be any that you should really be too weary about. But if you do have someone individually and they have like their own I don't know, like system or tool that they use, and they want, you to send them money so they can put it in there, and they said they're going to return it with, a certain amount interest or something like that, that may be a little skeptical. I wouldn't do it personally. But whenever you're looking at those major companies, I wouldn't hesitate too much. because once you put your money into those accounts, you're able to do what you please. You don't even necessarily have to do anything with those funds, depending on the account, if they have like a minimum amount or something like that. But you can literally keep your money into that account until you're ready to make that trade. And I don't know if you were kind of asking this about like, are there stocks that I have red flags? I don't know if that was a part of your question as well, but if you see a stock and the company doesn't have much information on themselves, it's a fairly new company. Usually anything that's like less than $5, you kind of want to be a little bit hesitant about and kind of wait and do some research a little bit further on those types of companies. But you definitely want to make sure it's an established company. You want to, I mean, if you want to get into the weeds of it, you have to look at their like financial reports and things like that, just to make sure that they're at a good financial standing. Because there's a lot of companies that you think they're doing great, like Tesla, for example. People love Tesla. It's like a provocative type of company. It does great, et cetera. But when you actually take a second and look at their financial reports, Tesla is not the greatest company to be investing in. But you know, it takes that research, it takes that understanding. Just like with any skill, just like with any hobby that you pick up, you want to learn more before you just jump right into it. So again, I would say if anything looks sketchy, if it sounds too good to be true, if they want you to pay money first so they can, you know, do certain things and they'll give you money back, like you kind of want to take a second to think first before doing anything like that. But if it's a major company, those major stockbrokers, you should be able to sign up an account, and those are pretty much legitimate.
Okay, thank you. Yeah, you answered my question and then some.
Great, no problem.
Monica, did you want to chime in on that one?
No, I agree. Brianna covered that one.
Okay. Are there any other questions from the group? There are two tidbits that I did want to share. In addition, hold on, wait, do you have a feeling about? Okay, someone wrote in the chat box.
So our Faith was speaking about this tool app or site called Betterment. They actually go over your spending, how to set financial goals, making your financial goals real. They go over savings, investing, IRA, and 401k. So it's kind of like a one-stop shop. I am not familiar with them, but I say get familiar with them before you make a decision, as with anything. So it seems like they do want to provide you a good tool. So just look into what they have available.
Thank you, Sarah Monica. I also wanted to talk about just two different topics that are related specifically to what we're talking about tonight. It's very important to understand the relationship that you have with money. If you view it in a positive light or if you view it in a negative light. I know a lot of time our experiences are kind of shaped by things we've experienced in our lives, kind of things our parents may have gone through. But money is a good thing if you're fiscally responsible and you're doing what you're supposed to be doing with it. So I don't want, anybody on the call to be discouraged wherever you may be at in your life, whether it's, your job, trying to figure out paying off debt. It is what you make it. You want to do the best thing that works for you. And like Monica and Brianna have shared, you want to make sure that you're taking care of all your expenses that you have. You want to make sure that you're paying off debt so that you can redirect that money back into your budget to maybe treat yourself or to, work towards a financial goal that you may have in the future. So that is very important. When you talk to your kids, speak to them about money in a positive way, because again, like I said, sometimes we view it as a negative way. So if you view something in a negative way, you may not always treat it the best. You may not have the best perspective, in regards to pursuing different financial outlets for yourself. So when you're speaking with your children, educate them about the importance of budgeting, the importance of not spending everything that you have. That is a real thing. A lot of kids, we're kind of in a different situation than maybe our parents, doing more, doing better financially. So we're able to provide more for them. And it's important that you instill in them too the importance about, this is what I do, every day to go out and make money. You can't just spend everything that you have, because if you do, then you don't have anything to look forward to. So that's very important. Another thing too is you want to know different triggers or like habits that you may have so that you can watch those when you're kind of planning your financial goals and sticking to your budget. Believe it or not, there are different types of spenders that individuals kind of possess. So you could be an impulsive shopper. You could be one that just tries to shop specifically to try to outdo the Joneses. So you really want to educate yourself and list things that may trigger you in regards to spending. Because again, Monica did a great job talking about the budget, but it means nothing if you're not going to stick to it. You can create a budget all day, but if you're not going to stick to it and you're not going to be responsible with managing your debt, then you're going to be in the same situation and constantly be in the red. And that's not a thing that you want to do. So those are just 2 tidbits that I wanted to share. Do we have any other questions from anybody that's on the call right now? Comments? I do want to share one thing. I'm going to share my screen really quick, just to kind of update you guys on some upcoming events that we do have going on. So you guys can see here specifically, we always have stuff going on, you know, even in virtual land. But we do have our community midday prayer call that typically takes place every second Wednesday of the month. So you can see the number there. And I'll go ahead and read that out for everybody because it is a little bit small, so I'll zoom in a little bit, but the number is 605-313-4464, and the access code is 68232. And again, this takes place the second Wednesday of every month. Feel free to join. You can also send in any prayer requests that you may have, and we will continue to pray with you throughout the month or in a particular situation. Again, because it's Financial Literacy Month, we will be having tomorrow our Little Girl Big Dollars. This is not only exclusive to little girls, young men can be included in this as well. The goal is just to talk about the importance of what money is, how to make money, being fiscally responsible, instilling that in our children at a young age, because as Brianna stated before, that myth that we don't teach our kids about money is just that is not correct. It's a false statement. And we want to do what we can to continue to make sure our kids are financially, fiscally financial. Also, we will be having a Black Business Expo that will be taking place on April the 18th. If you have a business and you're interested in participating, please reach out to us via our email so that we can get you added to the roster. We will be talking about how Black business owners were able to be resilient during the pandemic. As we know, a lot of Black businesses took a really big hit. Some of them didn't qualify for some of the PP loans and et cetera that were offered by the government. And so we want to do what we can to support our brothers and sisters that have businesses and making sure that they are able to be successful in the future. 2 other things that we don't have listed here. We will have a bonds that can't be broken forum discussing the importance of a mother and daughter relationship or just having positive relationships with women in general. That will also kind of encompass a SIP, a mommy and me SIP as well. So we'll have more information that will come out about that. And then we will have a mental health forum that will be held in the month of May, which is Mental Health Awareness Month. So I did want to share just those couple items to be on the lookout for. We have a number of different social media outlets. We have Facebook, we have Instagram, we have YouTube. We also have our website. So feel free to check those if you're ever wanting to stay up to date about what events that we have going on. Before we head out, I just wanted to do a special shout out to both of my SOARs, SOAR Brianna Clemens, SOAR Monica Disro, for just doing an excellent job this evening and extending your expertise on both of these topics. You guys did a phenomenal job. I'm very grateful and appreciative of you both. And they do serve as our Target 3 chairmen, which is the economic legacy target. So go ahead and give them a round of applause. You can do a virtual hand applause, or you can do the little reaction. But they did an awesome job, and I really want to thank them for bringing this event to life and doing an amazing job. So Brianna, Sora Monica, do you guys want to share anything? Really fast?
No, it's a pleasure. It's always a point of being grateful to share what knowledge that we have. So I appreciate it.
Yeah, same for me. I'm just glad that, we have people that are wanting to know this information, willing to learn, and just have questions. You know, no question is a dumb question. You don't know till you ask. And I'm just grateful to be able to empower people that look like me that are in my community with this type of information, because it's very pertinent. And like even our poll question showed, you know, we are trying to educate our families, our younger ones, just to have that insight on financial, because it's very much important. So thanks everyone for coming out and, well, tuning in and joining us tonight about this.
And again, like I said, thank you both. On behalf of the Gamma Kappa Omega chapter, I just want to thank our guests for tuning in. Again, it's not over. Like I said, we're coming back tomorrow for the children, and then we're going to have our Black Business Expo on the 18th. So we want to thank you all, like I said, for joining us this evening. I hope it was as informative, fun, educational for you as it was for myself, even being new kind of in this field. And like I said, if you guys have questions, definitely feel free to reach out to us via our email or our social media accounts. And then I'm sure Brianna's gonna be having her business venture that's gonna be coming soon. Monica does have a tax business, and she's also in some real estate. I'm offering some financial planning services as well. So if you're interested, definitely get in contact with us, and we'll do what we can to assist you. And we will be making sure that this is available to those who could not attend tonight, because we did record it. Again, like I said, we want to make sure the information with others, because it is beneficial to our community to make sure that we're getting that information out. So like I said, again, ladies, thank you all so much. I hope everyone has a great week and weekend. Happy early Easter. And again, thank you guys for continuing to support GKO and our virtual programming and our fundraisers and all that we do. All right, you guys have a good night.
Everyone, have a good evening.
You too.
Thank you. Have a good night.